On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
23 to 5. Hard to believe it's Friday again already, isn't it?
We're just blinking.
Here we
here.
are.
Here we are.
Absolutely.
It's
Today
crazy.
we're here to talk about how much tax do I pay if I go back to work after retirement. Now, hang on a minute, Luke. That's against the rules. You can't go back to work after you're retired. That means you're not retired.
Well, it depends what your definition of retirement is, doesn't it? Look, this one, for a bit of context, has been quite topical, and I've had a number of people come in this week and say, all right, well, I'm going to be done, end of August, but I'm not going to go back because I'll get absolutely smashed in tax. And I asked them, well, why's that? Oh, because I will. Like I also had a lady tell me this week, she came in and she said, oh, well, I'm 60 in a couple of days, so I've got to take all my super out. Oh, have you? You going on holiday or you buying a house or something? She goes, no, it's 60, I've just got to take it out. And the point of today is to just try and demystify some of the general assumptions that I have on a day-to-day basis. And one of them is, well, I can't go back to work because then I'll get smashed in tax. No, you probably won't. And the reason I say that is when you start an income stream from superannuation and you're over the age of 60, you pay no tax taking that money out of your account. So if you're paying nothing and let's say you drew $100,000 out of superannuation as your annual pension, and let's say that was between you and your spouse, so you got $50,000 each, and you go back and do 2 days a week as a dental technician, okay, because you love teeth and you love talking to people, that's great. I'm pro people using work as a resource to fund the way they want to live, because not everybody has the accumulated assets in their superannuation, their investment properties, or whatever else it may be, to be able to fund a commensurate level of income that was similar to what they were earning when they were working. But we need to come back and say, where has the money come from and how is it taxed? We can't leap to, I've got a big number, which I then assume is going to be taxed and cause me a platform for other income. So if you take it out over 60 as a lump sum or a pension, you pay no tax. For the defined benefit members out there, you can't assume that that applies to you because your rules are different, okay? That's a horse, that's a unicorn. They are not the same. But what you do need to do when it comes to the defined benefit side of things, you're going to have 3 categories of accumulated interest. You're going to have a tax-free component, a taxable tax component, and an unfunded or untaxed component. Now, as a general rule, you can look at the untaxed portion of your benefit and assume that that will be fully taxable income and you are entitled to a 10% rebate. That is what you need to keep in mind, because people come in with one of those income streams and say, well, I'm going to get $85,000, but I'm not going to go and work because I'll get walloped in tax. No, because the tax-free component is tax-free. The taxable tax component is tax-free. The unfunded portion will be taxable, but you'll get a rebate. So again, don't assume. That's all I want people to take from today. Don't assume it's bad, because it's a very generous tax scheme. And over 60, everything's tax-free from normal super. So don't assume that tax is bad, because you also have the ability to make tax deductions to super to lower a high level of income if you do decide to go back to work. So you really need to just remember, where has the money come from? What have I earned in total? And in your bucket, whether it's from a defined benefit pension, whether it's rent from a property, whether it's bank interest in your own name, whether it's superannuation pension, what is taxable in my name? And then work out the tax payable on only the assessable part of your benefit. Again, assumptions are killing people. And I think a lot of people wouldn't mind going and doing something for their own mental health and their own engagement and their own sense of community. But more often than not, I have people say, well, I can't do that because of the tax, when there actually isn't a tax problem. Because if you earn up to like $20,000 and you've got no other taxable income, you're going to pay nothing or next to nothing. There's a few other rebates involved. You probably pay nothing. But again, speak with your accountant before you go committing to a part-time contract with the government or a third party, because there are strategies that you can use to lower your taxable income. But it all comes back to, what have I earned? Where did it come from? And I think if people can get that as their starting block, they can make some really good informed decisions around how they spend their time, because a lot of people wouldn't mind going out and doing something. I said to a gentleman the other night, you want a new boat? Cool, I'll do you a deal. Earn me $25,000 working part-time or save me $500,000 in super. Which one's easier? So now we're shifting our thinking to some part-time work is now a resource to fund the way we want to live, for the decisions we want to make, because $25,000 of part-time income will have a negligible amount of tax on it. $500,000 in accumulated super at 5% gives you the same number. And I can assure you, it's a lot easier to earn 25 grand than it is to save $500,000 of after-tax money to get into your super fund. So if you have a clear understanding of the implications in relation to tax, that can give you greater clarity around the decisions that you make. Do I work? And if I do, how much? Now, you probably don't want to retire and then go back to full-time work. Look, if you're lucky enough to do something that you're passionate about, wonderful. That's great. And I think if you can stay part of a community from an employment perspective and it suits your lifestyle, all the power to you. If you finish and say, well, I wouldn't mind just doing that, that's great too. Do a 3-month contract, do a 6-month contract, have 6 months off, go to Europe, come back, get a job in the cold. Don't work while daylight savings is on because you can play golf every afternoon. Lovely. But go into an occupation from a part-time perspective, understanding the tax implications. Don't let chat around the mahjong table with the ladies deter you from something that could be really beneficial to the way that you fund your retirement as part of a couple or as an individual.
Now, I'm going to put something to you, and you can tell me if I've got this right or if I've got this wrong. But say I have retired and I'm now drawing an income from my superannuation. It's in the income phase. Okay, and then I get bored and I decide, well, maybe I should go back to work for a couple of days a week and make a few extra dollars. Would I then be in a situation where I could put all the money I earn back into a super fund and live only on the money that I'm drawing out of my super fund, my income fund, and that way get the tax deduction on the money I'm putting in and still enjoy the income I'm getting from the fund?
100%.
So I get free money, in other words.
100%. However, let me caveat with this. You want to be sure about what you're earning, because you could have great behaviour and say, I'm going to put all the money I get from my wage back into super. But if the super contribution rate is higher than your marginal tax rate, you're doing yourself a disservice. And I see this a lot, because that mentality is fantastic. I'm going to save for retirement. I'm part of community. I'm working. And the money that I'm getting, I'm throwing into super. It's bolstering my account. Wonderful. But keep this in mind. You pay 15% tax up to about 50, 55,000. Okay, because you get the first 18 for free, then we go 19, then we go 34. But if you average that up to about $55,000, the tax rate's 15%. So if you were working part-time, earning 40, and you took that as salary, you will pay less than 15% on the income that you earn. If you put that $40,000 contribution permitting into super, you're choosing to pay too much tax. So you would do what you just suggested there. If you've gone back and you're earning 80,000, get 30 or 40 into super, provided you have the cap space, wonderful, and then take some as wages to maximise the tax-free threshold in your own name. And that's why I say you've got to check and see what's taxable and what your position is, because great behaviour like that is a wonderful initiative, but you could be accidentally doing yourself a disservice because tax in your own name may be less than the contribution rate. But you can 100% do exactly what you've suggested. And that's what people need to be thinking about.
Okay, but there's always more to consider than you might immediately think, isn't there?
Yeah, look, exactly. And if you do that in that example, you would need a new account to receive the new superannuation, because one of the rules of starting a pension is you can't add to its capital value without stopping the income stream. So in that situation, you might have $1 million in your super fund and you're taking a pension out of that tax-free, great. And you might be earning $50,000 over here on the right and receiving that as wages and maybe putting some of that into superannuation, because you may also have rent from investment properties. You might have money in the bank and you're generating interest, where a deduction, as you've said, could be very beneficial when you look at your total taxable income. And this is where getting some good tax advice is really important, because more often than not, people do exactly what you suggested, which is wonderful behaviour, but horrible from a tax outcome perspective, and they don't even realise.
Yeah.
So it's important to keep that broader tax position in play. But you can 100% do both depending on what you need.
Always look at the fine details.
Exactly.
Indeed.
Exactly right.
Luke Smith is with me from Envision Financial today. We're looking at how much tax will I pay if I go back to work after being retired. We'll be back with more in just a moment. Eight minutes to 5 now. Luke Smith from Envision Financial is with me in the studio today, and we're talking about how much tax will you have to pay if you go back to work after retirement. And Luke, I started off by saying, look, if you go back to work, you're not really retired, are you? But of course, you've pointed out that it's a really important and useful thing for people that might be interested in bolstering their income while retired, and they don't necessarily suffer the penalty and tax that they might think they do.
No, look, exactly right. And I think it's about shifting that mentality of part-time work. Look, I can understand it. You know, you get to 58, you've worked your whole life, 60's not far away, and you're thinking, oh, what, more part-time work? But when it's for your own reasons and for your own purpose, I find the attitude towards it is very, very different, because it's probably not in what you've done in a career. You know, 2 days a week at Bunnings, like, heavens forbid if I ever ended up in there, there'd be plenty of people in lots of trouble, because anyone that knows me knows I do not need a hammer in my hand because I'm hopeless. My wife will attest to that. But again, it's something that you can do to generate some more income. The other thing I find people get a lot of comfort from is it reduces the percentage that you may need to draw from your accumulated assets, which can then help with the longevity of your money. Because one big concern everyone has when they turn off the income tap is, well, how long is it going to last, and can I do the things I want to do? And a little bit of compromise might be, well, you can do A, B and C, but if we only take 4% out of your super, not 8, it'll last a lot longer. How do we do that? We go and get a bit of part-time work. Now, I'm not talking 100 hours a week. I'm talking, something that is suitable for your situation and from a time constraint perspective fits in with the scheduling of the things that you want to do. That's the nice thing about contracting now. I've got plenty of people that do that. I'll do 3 months in that contract. I'll have 6 months off. I'll do 3 months again in February. Great. And you can do that as and when you want to fund things. But people need to remember that pension money coming out of super over 60, tax-free. Your tax is worked out on your total income from a taxable source. So if you've got 100 grand coming out of superannuation, it's tax-free, then that's not the foundation that your tax is based on. It's from a taxable source. And we said before the ad break, that could be some bank interest. It could be rent from a property. It could be a contract from work. It could be part of a defined benefit income stream from CSS, PSS, DFRDB, MSBS, less the rebate. So again, there may be implications. And if you do decide, well, hang on, I'll go full gas for 6 months because I want to go to New York for 3 months and I need some money. Wonderful. You still have the ability to make deductible super contributions to lower your taxable income, which further bolsters your superannuation and lowers your tax. So there's always a way to get around giving the tax department any more than they deserve, which if you're not doing, I think you've got rocks in your head. But again, it's the assumptions we're trying to get rid of. If you're not working, you might want to sell an investment property. Does that mean you've got a lot of taxable income that year? Yes, because capital gains tax is just income tax by a different name, calculated slightly differently. Now, if you've done something like sell an investment property and you're not working, then you may not want to work in that year because you've already got a very high level of taxable income depending on the property. So use deductions to lower that. But if you don't have that sort of ad hoc situation with assets, You can go and work the hours that suit you for your mental and personal engagement, and also then to take some pressure off your capital and live the way that you and your partner may want to live, which I think is a wonderful thing, because my definition of retirement has always been, can I say no to more work and still live the way I want to live? If you can, then for me, you're still retired. You're just choosing to be engaged in something else for a few bucks, which isn't a bad thing.
It certainly is not. And if working part-time means you've got a bit of extra money, then you can always put it back in your super anyway.
Totally, 100%. 100%. Like a merry-go-round.
Yeah, well, like I said before, it's almost like free money. All right. So at this point of the program, Luke, I've got to ask you, where can listeners get more information?
Yeah, so office number 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the podcast, The Strategy Stacker, Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube. So we've got the channel there with a backlog of all of our shows, so you can watch that on your phone. And all of these types of considerations and strategies are in Smart Money Strategy, your ultimate guide to financial planning, just about everywhere you can get hold of a book.
Absolutely. It's in actual bookstores. It's online. It is readily available, packed full of all sorts of useful information. And as the title would suggest, strategies that are smart.
Exactly right.
Indeed. Of course, it's the 1st of August today.
It is.
It's almost time to start thinking about your Christmas shopping.
It is. It
yes.
is. It's
so
quite frightening.
You can stuff a copy of Smart Money Strategy into somebody's stocking, and they will be forever grateful for your thoughtfulness and kindness. Luke, thanks very much. We'll catch you again next Friday.
See you next week.
Luke Smith from Envision Financial, and Luke will be back with us again at the same time next Friday afternoon right here on 2CC.